market has performed very well, particularly in resources. We still think there's significant earnings upgrades yet to be had over the next 12, 18 months, driven on the cyclical recovery we are seeing globally. And that's despite some of the actions or comments coming out of China. We still think it's not just China growing, we think the rest of the world is. And that's at a time when supply is relatively constrained and demand's increasing from a cyclical perspective. But we also do believe there's a bit of a structural element as well, which is the decarbonisation story, which is going to continue for many, many years. So against that backdrop, we see a lot of commodity prices. We see a lot of commodities and commodity prices remaining elevated for an extended period of time, which the market, in our view, is not forecasting it to be the case over the next couple of years. So we still see significant upgrades. So we're still staying with our overweight resources story.
Paul, to the question that most investors are kind of debating on right now, which is inflation risk. As an investment manager, how are you pricing that into your portfolio at a time when yesterday in the RBA's comments, while they said that the headline numbers won't change and that, stuff on wage inflation as well as the overall consumer inflation would remain subdued, they are looking at labor shortage issues in some parts of the economy. Do you think that that can actually spiral out into a bigger problem?
Look, that's one of the areas that we have identified as a risk as in inflation, generally speaking. And certainly wage pressure is certainly something that we are looking at quite closely. The way that we're looking at things right now is we do see some pressures, but it really is only confined in certain sectors. It's not Australia-wide. So we think against that backdrop, we think inflation should still remain relatively contained. But there is a risk, and that's a risk that we are looking at. If that is the case, we'll see the yield curve shift up a little if that's the case. But the RBA and even the Fed have indicated they're unlikely to raise rates until we see full employment, and that may be some time away as yet. So it is something we are monitoring, and we do identify that as a risk. But if rates do move up a little, we think the banks will benefit from that, and also a few other sectors such as insurance, which we are quite overweight. So that is, we're there by design because of that risk.